Welcome to Cash Flow Savannah, episode 47. Chandler, how do we get to 47? I'm pat myself on the back right now.
I don't know. I'm just keeping it consistent, making sure we get one. And honestly, I think we enjoy it. So it's easy to keep going.
I do enjoy asking lots of questions. And for
Yeah.
our audience, I want to apologize. We've missed a few weeks. I've had some personal things going on with my mom who's not in great health. And I am so sorry. We have definitely missed a few, but we're going to get it together and stay consistent after that. I'm committed to this.
We'll make up with some really good episodes. So
Yes.
I think we're fine.
I hope so. Well, today we have our friend Tanner Macklin. He's from Easy Street Capital. He represents a very large lending institution that I have worked with as an agent. And we're just so excited. Chandler and I had the opportunity to ask him any question we wanted. And it was fun. I think we got a lot out there that has never been put out there. What do you think, Chandler?
Yeah, no, I'm very new to I don't know a lot with lending, especially that side of lending. So yeah, I'm very open-minded and just kind of ask what I can. So
Well, and in real estate, your lender becomes your partner, okay, immediately. Like it's important to choose the right lender, find the right terms. And one thing that I feel like really came out during this episode was that there's a lot of misconceptions about lending as real estate investors. And so Chandler and I, our brains were going, and I started going, well, hey, what about this? What about this myth? What about this myth? And almost every one of them was untrue. I'm going to start off with the one where people go, oh, you can get 100% of your cash back right away. Not true. So it was really interesting asking him about those different myths, about risk. So, anyway, this is a really great episode. So, please stay tuned. And we really thank you guys for watching today. Welcome to Cashflow Savannah. Today we have Tanner Macklin. How are you today, Tanner?
I am doing fantastic. Thanks for having me on, Julie and Chandler. It's a pleasure.
Absolutely. I've known about Easy Street Capital for a while. You guys are an investor focused, lean, how do you say, investor focused banking. Is that correct?
Yeah. We're a direct private lender, and yeah, we strictly focus on non-owner occupied properties, and so investment purpose vehicles, real estate. Yeah.
Awesome. Well, just tell our listeners just a little bit about yourself, Tanner.
Yeah. So I started at Easy Street just over 10 months ago. It was at the beginning of August last year. Originally, I was working as a commercial real estate agent for 2 years. And so was already real estate adjacent. I mean, I was in the real estate industry and then transferred over into the lending side. I actually got a master's in finance. And so I just felt that it was a natural transition, taking my sales experience as well as my finance experience to then join the lending and finance side.
Wow. Do you have investment properties yourself?
Not yet. Not yet. That is certainly the goal. Yeah, I think probably by the end of Q2 2025 is what I'm shooting for to get my first door. And then, of course, scale from there.
cool.
Yeah.
So can you kind of just explain what private lending is, for just the audience?
Yeah, so we are working directly with investors, and our internal guidelines are created by ourselves. Our guidelines are our lending requirements, et cetera. All those are set by us versus when you go to like the conventional or traditional routes, they're really set by Fannie or Freddie. And so what that enables us to do is get a lot more creative with the different types of deal scenarios and different properties as well. I mean, we do condo hotels, we do non-warrantable condos, just to name a couple of those products that we do offer that Fannie and Freddie don't like looking at.
Okay.
You guys asking for a friend, literally. Do you guys do trailers?
We do not. Yeah, so we are not in like manufactured mobile homes, trailers. We're strictly single family up to typically 4 units, so fourplexes. We have a little bit of bandwidth for 5 to 10 small multifam, but really our buy box and our lending box is going to be in that 1 to 4 unit.
Why is it that it's so difficult to get financing on like trailers and manufactured? I have a friend that's been really beating the pavement for a loan.
Yeah. I mean, the primary issue is that it's not sponsored by Fannie or Freddie. And so you're going to have to go the private lending route. And so what comes with that is a lot more of like a wild west type of scenario with financing. And then when it comes to like the manufactured mobile homes, I mean, they can get uprooted and lifted and moved somewhere else. And that's going to be a primary factor for why it's harder to secure financing, where the collateral could effectively disappear overnight. That's going to be a primary reason.
Interesting.
Yeah.
Yeah, that's interesting. So Easy Street Capital, that's right. Correct. Easy Street, is that how you say it?
Yeah, Easy Street Capital.
Right, Easy Street. So let's say you have someone new that wants to come in. What are some of y'all's requirements?
Yeah, great question. So we are for a borrower specific, we are looking at their credit. And if it's a purchase, we're looking at, do they have the cash to close? So for example, if we're giving them 75% LTV, which is 25% down payment, if they're going to bring 25% down, we want to see that they have those funds, as well as they have the closing costs, title, escrow. If there's origination fees attached, we'd want to see that as well. And also there's going to be a reserve requirement. Typically that's just dependent on the loan size. But really that's going to be a lot lighter portion. For example, if it's less than a $500,000 loan size, we only want to see 3 months of reserves, as well as a down payment, as well as the closing costs. So really it's just verifying that they have the funds to close the deal. And then we also will consider their experience. So for example, on a short-term rental, we do have the ability to qualify through AirDNA. And what will come with that is either 100% of the value if they are an experienced STR owner. If they're not, we will just apply a haircut to that value of 25%. So we'll use 75% of that AirDNA value to then qualify. And so the requirements for the borrower specifically are exceptionally light. I mean, it's like I said, it's the credit. We want to see that they have the funds to close. And then in some instances, we will consider experience.
So you're saying, like, if someone has maybe 5 long-term rentals already, they want to buy number 6, you want to see the down payment plus a little bit of reserve. But wait, say that again. For a short-term rental, you'll do 100% financing?
So I should take a step back as far as the qualification outside of the borrower. So what a lot of our financing is based on is strictly the property itself. And so like the DSCR loans, that's the loan product, or one of the loan products we offer. We are using the property's cash flow to qualify the loan versus the investor's cash flow, which is going to be what you see in like the conventional traditional route, where they're looking at the W-2, you're looking at their DTI, sometimes their tax returns. I mean, they really want to see exactly what your financial position is as a borrower before being able to qualify you for a loan. What we do is we look at the property income to support the mortgage. And so that's why it's a very limited requirement specific to the borrower. And a lot of it actually is tied into the property. And so with the short-term rental, 100% of AirDNA is a third-party data aggregator. They look at comps and they say, okay, well, this property is projected to make this much revenue based on really it's a bedroom and bathroom count is like the primary consideration they use. That's neither here nor there, but we use that value to then qualify the mortgage. For example, if the AirDNA is saying that this property is going to make $4,000 a month, we want to see most often that their PITIA, their principal, interest, taxes, insurance, and association dues or HOA dues are less than that $4,000 number. Effectively, that is cash flow positive. And so what comes with that is if they're an experienced STR owner, we can use 100% of the AirDNA value to qualify them for a mortgage. Or if they're not, then we'll use 75% of the AirDNA value to qualify them.
Okay, interesting.
Okay.
Yeah.
That can be tough because it's really hard to get like short-term rental numbers. So I bet it's tough for y'all to kind of go, "Ooh, I'm not sure."
Yeah.
You have to run STR numbers.
Yeah, I mean it's a wild west too with short-term rentals. I mean, you go to some vacation markets and they don't really have a good delineation for like a beachfront property that is almost certainly going to rent for more than one that's even just 2 blocks away from the beach, right? Even though they have everything else the same amenities, the same bedroom, bathroom count. AirDNA is going to say, hey, this is probably going to generate the same amount of revenue as this other property that is a beachfront property. Doesn't really consider very like edge cases like that. That's one of the few edge cases.
Yeah.
But outside of that, we've found it to be very highly accurate. I mean, it's accurate in 90% plus of cases. And so that's why we do add a little bit of a haircut for brand new borrowers, brand new STR owners, because there is some uptime to understanding the nuance with those platforms like Airbnb and VRBO. and really effectively managing your short-term rental.
So how does one qualify and say, hey, I'm a sophisticated investor? What do you use to qualify that?
Yeah, so the delineation there for an experience to get to 100%, we want to see that you have 12 months of operating history with a short-term rental in the same market. And the same market's typically plus minus 50 miles away. I mean, we've done like beachfront property in North Carolina. We've qualified them for a beachfront property in South Carolina because it's going to be a very similar market. However, typically it's going to be the exact same market, just one, or there's 3 that they have nationwide with 12 months of operating history. And then that would qualify them on a go forward up to that 100% AirDNA value.
So if they had 3 in the Smokies and they were going to buy 1 on Tybee Island, you would consider that as a seasoned investor, even though they don't have any others in Tybee Island.
Exactly.
Interesting.
Exactly. Yeah.
Yeah, loan qualification is tough.
I mean, borrowers, when they go through our process and our requirements, they leave with a breath of fresh air, because it's so much lighter. I mean, when you go through the conventional traditional route, I mean, they're basically holding you at a dentist chair and pull out your teeth to get everything about you. I mean, they want to understand everything about your financial situation before giving you a loan. And hey, understandable. The government is subsidizing these loans. That's what Fannie and Freddie do. However, for us, we are creating these internal guidelines, and then we are creating a business model around the profit of course from these loans, and that's how we are able to give out these funds on a consistent go forward or on a rolling basis. I mean, we're averaging roughly 100 million in loan volume a month, so we're very active. I mean, these loans are really starting to hit the mainstream, these DSCR loans, and also like the fix and flip ground up construction loans.
So Tanner, I have a lot of buyers and I always encourage them, and that's usually their plan too. They're wanting to buy 1 a year, right? Minimum. And so would you say, let's say they do their first loan with you and they're a newbie, and then they do well, and then year 2, they're going to buy a second loan. Is that loan qualification process a lot easier the second time around when they already have a loan with you?
It's going to be the same. The difference would be the only time that there would be less requirements would be if we have a loan file that we're doing with them, and usually within a month or 2. And the reason I say that is, hey, we've already collected your driver's license, the 2 months worth of bank statements that we use to verify that they have the funds to close, as well as like the credit. So we are going to be pulling their credit, and those are typically like the credit report is good for up to 120 days. And so really, if it's a full year cycle, it's going to be a very similar process and similar requirements. However, it's already a much lighter documentation load than what they're already experienced to and accustomed to, I'd expect. And so from there, I mean, it's just easy every single time. I mean, we do some loans with borrowers, 20 loans in a year. So there's not like a concentration limit or a loan limit for investors. It's really, do you have the funds to close? And of course, do you have good payment history throughout this process?
Okay. So do y'all negotiate the funds to close? Like, let's say it's just like a steal of a deal where y'all be like, oh, okay, we'll give you 100% or whatever. Do y'all negotiate that at all?
We do not. So we're always going to want to see, and that's part of the nuance with this specific loan product, is we do want to see that the borrower has skin in the game. And so our maximum leverage on a purchase is 80%. If they were getting a deal well below market, we are going to we're going to leverage off of the lesser of the purchase price and the appraised value. So if the appraised value came in at 200,000 and they're buying it for 100,000, we'd still just be leveraging off of that 100,000 because that's their purchase price.
What if the property needs a rehab? Are you able to help with that?
We are. So we have 3 different loan products. The first that we've been discussing this whole time is the DSCR side, the debt service coverage ratio loans. The ones that, hey, these are 30-year mortgages. We're using the property cash flow off of this. The second product is our rehab loan or fix and flip loans. And so if the property does need rehab, we have actually that's how we started as a company, Easy Street, 15 years ago. Our 2 founders, they did roughly 1,500 doors across California for over $1 billion in value. That was their business. They were just fix and flippers. That's all they were doing. And they saw a real need for a quality lender in that space specifically. And so what came of that is of course, Easy Street. But now today, what that translates to for the borrower is we have an underwriting team in-house where when you do a loan up front or you're purchasing a property up front, our underwriting team is analyzing the deal and coming to a value similar to what an appraiser would do to completely eliminate the appraiser requirement on those fix and flip loans or those rehab loans. And so if they're looking to do, for example, they're purchasing a property for 150,000, they're going to spend 50,000 in rehab and they're expecting it's going to be worth 250 when they're finished. That process is specific for that loan. That loan is designed for that exact investor, that exact situation. And we're going to lend them up to 85% of the purchase price and 85% of the rehab. And so the $200,000, it'd be $170,000 loan size. And the loan allocated to the rehab would just be accessed through a draw system.
Okay. Oh, I'm very curious now. You've got me going. So I'm just going to keep it simple.
Mm-hmm.
I buy a house for 100 and I need to put 100 in it. So I'm going to borrow 80,000 plus 80,000 more. So as the person doing the rehab or directing it, you want me to put in my 20,000 on the rehab and then start the draws, or how do you do that 80% of the rehab budget? I'm just very curious because I have no idea.
Yeah, great question. So we want to see that they have 80% or 20% down upfront on the purchase.
Right.
And then to get access to the draws and how it would work is, let's say they spend 15,000 replacing the kitchen cabinets, maybe they did some flooring, some painting. They would send in their pictures and their invoices. And by pictures, we actually use a third-party application called TruePic. They completely eliminates the inspector requirement. It's geo-tracked. They take pictures of what they completed. We know it was at the subject property because it is geo-tracked. Our draws team then will reimburse them up to that number. So if it was 80% of the rehab was allocated there and they spent 15 grand, we give them 80% of that 15 grand as a reimbursement.
That's interesting.
Yeah.
I like that.
Yeah.
So one question that's coming to me is, you were a commercial real estate agent. Well, what made you make the switch?
Well, I started in, I guess it was June 1 of 21.
Yeah.
And interest rates were at their lowest. The market was, I mean, as a real estate agent, your money is directly tied to transaction volume, right? It's how many deals are getting done, how many deals can you close. And so the more deals that there are available in the market, the more transactions that are happening, the more, like, the bigger slice of a pie, so to speak, that there is available. And I was successful for 2 years. I closed plus minus like $9.5 million in total value. Selling CVS pharmacies across the country was like my primary focus. But as interest rates started to increase, and it was also a perfect timing with the end of my finance degree. So I completed my master's in finance in May of 23. And so that was also I left in April of 23, commercial real estate business. And so it's kind of like the transaction volume had been on a steady decline, and I saw the writing on the wall. I knew it was going to continue that direction as well. I mean, most likely, I mean, I don't have a crystal ball, but I was expecting that to be the case. And it certainly has been the case over the last roughly year and a half since I've left.
Yeah. Commercial's getting hit pretty good right now. So.
Yeah, it certainly has. It's definitely a tough market out there for real estate agents, specifically commercial as well. So my thoughts and prayers go out to those still grinding on the wheel there.
I want to share a question. As a sophisticated investor, I have one DSCR loan, and I've always worked in the commercial product because, years ago, I hit to where I couldn't get any more conventional loans. So I had to go commercial. Now I was always very happy with that product. But then, as you said, the commercial lending is just very difficult right now, if not impossible. And of course, I went to my commercial lender and they said, you're tapped out, no more. So I went with a DSCR product. And it was difficult. I have a large portfolio and they wanted a ton of paperwork. And I was like, okay, fine. This is a new lender. I get it. I've been self-employed for over 20 years. It was brutal, but I did it. I needed the cash out refi so I could continue rehabbing. This was last year.
Okay.
I have another product now, which I had spoken with you about as well, Tanner. So it came up. I was at a point where I was worried that I would have to cash out refi another property in order to continue the rehab. So I went to the same lender about a DSCR loan, and they said, and it had been less than a year, and they said, oh, we're going to need every insurance policy, like basically every bit of paperwork on every property I own. And I mean, I canceled the whole loan application at that point. I just said, no, I'm not going through that again. I just felt very strongly with my long history and the fact that I'd already done one performing loan with them. I spoke with Easy Street, because I was just horrified. You're talking a lot of properties having to dig up paperwork on. It was just, I said, hey, I don't need it. What are your thoughts on that? Do you have, because people talk like the DSCR loan is so much easier to get, but then in my experience, it really was almost worse.
Interesting. Yeah, I know we had this discussion, but we don't have that type of requirement as far as we want to dive deep into your entire real estate portfolio. The extent of what we would want to see if, for example, you're using a short-term rental or you're going to qualify through that AirDNA route that we've already touched on, that would be where we'd want to see that you have the 3 short-term rentals. And the extent of that would be the property address and maybe your booking history, just to see that you are successfully operating these. But that would be it. I mean, we certainly are not requesting a full portfolio of your properties and seeing the insurance policies of different properties. I mean, that is ridiculous. And I would say I'm happy you did cancel the application, because there are going to be lenders specifically in the DSCR space that are not going to have those same requirements. And potentially what's happening there is all these loans eventually make it to the secondary markets. And so that's same with Fannie and Freddie. They're just a secondary loan buyer. It's really all these mortgages across the country are making it to these secondary markets. The secondary market for the DSCR loans are typically like insurance companies, mutual funds, players like that. And so it's probably their specific loan buyer who maybe got burned on like a specific property. Maybe it was like an entity owned like 10 different properties before, and they got hit by a hurricane or something. Their insurance policy didn't cover these other 8. Now their LLC went, bankrupt effectively. They can't pay their mortgage on these other 2 that they had, even though they were properly insured. And maybe that happened a couple of times. And so they said, oh, we're going to have to change our requirements. We need to see that they have insurance across their whole portfolio. That's maybe my guess is what happened there. It's just the secondary loan buyer got burned on it. And that's why now they're working through that. But what we do and what we were able to do specifically, we started our DSCR platform in 2022. So it is a relatively recent platform. That was when it was officially launched. We started working on it in 2021. Easy Street did. But we actually balance sheeted multiple loans for 12 months. So we had roughly 20 million in loans on our personal balance sheet for over 12 months to show that these loans were performing, and then taking those performance numbers and selling it to these secondary loan buyers and saying, look, our guidelines work. What we do works. Buy them and then go from there. And then that's how we're able to set up our own internal guidelines and requirements, and then, take that volume to those secondary markets and leverage that.
I felt very burned. Because, the whole sales pitch on the DSCR is it's easier, right? Or we just look at that property. And then, the first time I kind of took it on the chin, and the second time I said, no, you've misrepresented. And ironically, that bank, when I told them to take a hike, they came back and said, okay, we won't do it. And I said, no, I'm not working with you. Like, don't change on me.
Yeah.
But speaking of
you did the right thing.
Well, yeah, I'm still mad about it, but I'm okay. Like, I think it kind of worked out in my favor. But so, we've talked a lot about purchasing with a DSCR, and you're saying, 20 to 25% in cash down. But when I approached you about a cash out refi on a property that I owned without debt, that was not the number. I think it was 65% loan to value. Can you, what's the calculation on a cash out refi versus a purchase? I'm curious to know, because it was a new build cash out refi.
Yeah. So a new build, or really just cash out refis in general, they're capped at 75% LTV 70. Versus purchases at 80.
Okay.
The difference there, and the primary difference for the leverage, or the 5% difference there, is the appraisers are what we're leveraging off of on a cash out refi. And being in the real estate industry, looking at lots of deals, there's a very subjective nature involved with appraisers. I mean, one appraiser is going to say that this property is worth 400, another's going to say it's worth 360, another's going to say it's worth 410. And so you're getting a wide spread of value, specifically when it comes to a refi. And so to mitigate against that risk, there is that 5% cut as far as leverage goes. Whereas with a purchase, for example, we're comfortable up to 80% because we know, hey, the market price is the established value. You know, it was taken to market. Typically, it was listed on Zillow, these third-party sites. It was put on the MLS. And so what the best bid and best offer was, that's the market price. And so that's how we're able to do up to 80% on a purchase, but just 75 on a refi.
You're seeing a cash out refi as a higher risk, basically, than a non-market sale. That's interesting.
Exactly. Yeah.
Which makes
And so
sense.
so all apples to apples too, like a 75% acquisition loan is going to have typically like a quarter, maybe to 0.5% rate drop versus like a cash out refi, all else being equal, as far as like leverage.
I'm interested to talk about this, Tanner, because nobody's talking about this. And when you listen to podcasts, they all talk about how, oh, buy it, rehab it, cash out, get all your money back. They make it so easy. And I know it's not. I'm a very seasoned investor. And so I have buyers that'll tell me that all the time. Oh, I can just cash out refi in a couple of years. It'll be fine. And I'm like, in theory, yes, I agree with you. But in reality, just be careful because I'm trying to think if I've had any properties that I've ever been able to pull every single penny back out. I don't think it's ever happened. Because I've done cash out refis. You understand? I've done tons of them. And the bank always wanted to know, okay, we can see your purchase price. Now show us receipts for what you have in it, and we'll give you 80% of that. They were never willing to give me 100% back, even in the good days, of the lending, 4 or 5 years ago. So that's what I've always been said. I'm a little bit too honest, probably makes me a bad salesman. I have personally never gotten 100% of my cash out of a property. I've always been forced to leave some in, and I'm okay with it. And I feel like borrowers need to be aware of this.
Yeah, it's just an adjustment of expectations. I mean, it's really market specific too. I mean, if you travel back to 2021 when interest rates were super low and there were just a lot of deals happening, you could find great deals where you're purchasing well below what the actual value is. And then of course you put some rehab dollars into it. Now you have forced appreciation. That would be when maybe I could pull out all the money I put into the deal. But there's going to be very few and far between that you find deals like that. And part of that is just the competition. I mean, the fact that there are podcasts and there are YouTube videos and there's a lot of internet information available to investors to find out how you can successfully complete a rehab project. There's now a lot higher bidding market for these types of properties, these distressed properties. And of course, that raises the value for these or the purchase price for these. And so it limits those margins and of course makes it to where when you do have this exit, you're probably not going to be able to pull all your money out because you're not going to add, 50, 60% value on what your forced appreciate or your rehab dollars are anymore. I mean, you're going to have to add significant amount of value today. And that's just not the case. If interest rates go down where they were and those end buyers are purchasing, these homes for their families that well above market, it's like every day, hey, this property was on market for 10 days before I got 20,000 offers above market. It was an insane market. That was when there was like a 2-year window that was available. And it still is possible, but it's just very difficult to find.
Yeah.
One last question. I'm sorry, Chandler. I'll let you in 1 second. I'm on this vein. Let's say I get a killer deal on a property and I rehab it in cash. How long do I need to own it before you would allow me to cash out refi? That seasoning period is always a big question mark for people. So I'd love to hear your thoughts.
Yeah. Great question. So there's a couple of different things that we do. So after 6 months, it's treated as, and that's from the acquisition date to the note date of the loan. So our typical timeline is like 30 days. So we started in month 5, we would crest that 180-day mark from the note date. That would be we're going to leverage up to 75% LTV on a new appraised value, no questions asked. We're not going to need to really see exactly. I mean, we still will want to see your purchase price, how much money you put into it, but that won't come into consideration as far as us being able to give you up to 75%. The difference would be in 3 to 6 months seasoning, we can do up to 70% LTV on a cash out, but the loan size cannot exceed your cost basis. So that's similar to what you're saying, where the banks you said, oh, we still want to see what your purchase price was, how much you put into it. We'll still only give you 80% of that. We'll still leverage off of a new appraised value in that instance for the 3 to 6 months. It's just the total loan size cannot exceed your total cost basis into the deal, what you spent on for the purchase price, as well as the rehab dollars. And then 0 to 3 months, we would strictly be leveraging off of your purchase price plus your documented improvements, your rehab cost. So it's really just a function of what we're leveraging off of. 0 to 3 months, it's your cost basis. 3 to 6 months, it can be a new appraised value, but there is a limit to up to 70% LTV, as well as the loan cannot exceed your cost basis. But then after 6 months, up to 75% new appraised value, no questions.
So 6 months is the short answer.
6 months. Yeah. Short answer.
6 months. Yeah. Okay. Awesome. That's
not bad.
I'm really glad we got to talk about that, because that talk about.
So let me ask, what kind of separates y'all from other lenders? Is it, I know a lot of lenders, but it's the speed. We can get you money in a day or two, or less down payment. What kind of separates y'all?
Yeah. So on the DSCR side, it's really going to be the fact that we're able to create our own guidelines. Similar to what Julie already experienced, it sounds like the secondary loan buyers have a lot more sway in what the lender's able to do and what they require as far as documentation. Because we have great relationships with our buyers and we have a lot of leverage based on just the loan volume as well as our history of performance, we have a lot more sway as far as we can use up to 100% AirDNA. That is unique in the market. Most other lenders are going to be at 75%, maybe up to 80%. We can do up to that 100% value. Also, we don't have any cost consideration for a short-term rental versus a long-term rental. So some lenders are not as comfortable with the short-term rentals. And so if apples to apples, they say I'm operating this as a long-term rental, it's a 7.5% interest rate, but you told me it's a short-term rental now. Okay, it's a 7.75% interest rate now. Whereas for us, it would just be at 7.5% across the board. And so really what differentiates us is, hey, we can do the short-term rentals really better than anybody else in the market today. And we can even do rural short-term rentals as well. So that's going to be another unique product. A lot of lenders are not comfortable with rural properties. We can do rural properties up to 70% LTV on an acquisition and also use that AirDNA value to qualify them for those loans.
What makes the rural an extra risk? Is it because it might have lower occupancy, or what? Why the extra risk there?
So it's going to be that the secondary, for example, if you foreclose on a property, there's going to be a lot less or smaller buyer pool for it. So it's really just, are there enough comps in the area? Typically, there's not going to be. So it's harder to really get a good gauge of value there. And then also the rural markets are more subject, like the tertiary markets sway a lot more. They're not as weatherproof, so to speak, as compared to bigger metros where, they have a lot more insulation to the market.
Yeah, that makes sense.
Never gotten to quiz a banker on risk before. This is fantastic. I've always had these questions like, why is it more risky? I don't get it.
Yeah.
Cool.
I've never really heard lenders talk about the short-term rental market, which is cool that y'all do that. Like, that's not normally. I don't know if they do, but I feel like they kind of shy away from short-term rentals because it's just so.
Yeah.
It can be difficult to run numbers on. I know that.
It is, and that's why, I mean, like I said before, we had to hold these loans on our balance sheet for up to 12 months to really prove performance on these loans. And that's really what separates us in the short-term rental space for the DSCR loans, is because we've shown this. We were willing to put our own money on the line for those same loans, and hey, they performed as well. You can see that they're performing, and as a continuation, they still do continue to perform for them. And so that's how we're able to be more aggressive on the short-term rental side.
Yeah.
And then I did want to touch quickly on the fix and flip rehab loans. The differentiator there is we actually have a no appraisal requirement. I kind of touched on it, but our underwriting team is looking at these deals up front. And so instead of getting an account executive like myself or an LO looking at a deal and saying, yeah, this looks good. You get through, all the documentation, you submit all the required documents, they order the appraisal, it all comes back. Then it gets sent to committee or to underwriting. And then they have that final decision at the end. It's like, well, I just spent 2 to 3 weeks on this deal, and now you're going to tell me the terms are changing or you just can't even do the deal altogether. We completely eliminate that with our underwriting team looking at the deal up front. And so if we give you a term sheet up front, that is your golden ticket. We've already underwritten the deal. We're comfortable with it. All that's left is then we do the processing verification. Hey, send us in your documents, make sure that everything checks out there, and then we'll fund you. And so that process, of course, everyone says they do it quickly. Our underwriting team looks at it in the first 24 hours, and then we can fund in 48 after that.
Wow. Tanner, I love that you're saying this because I'm a buyer's agent and I've had so many clients find out the day before closing or the day of closing or 2 days before, your term sheet changed. You now need more cash. And it's like, it's brutal. In
It
fact,
is.
when I bought this home that I'm sitting in, I had that happen. Like the morning of closing, I was told I needed a lot more cash than I had. And I was so mad. Boy, I was mad. I can't even tell you how mad I was. It was just brutal. So that's huge.
Understandable.
Do that.
Yeah. I mean, that's what we're trying to eliminate, right? Is no one likes a slow no. A slow no is the absolute worst in the lending business. And so that is why we completely try to eliminate that, give you either a fast yes or a fast no. Maybe it's a slow yes, but certainly we're going to get to the yes in any case. And that's also lending to our philosophy with the short-term rental side is using Air DNA. We're able to pull that report up front. And so we know we can qualify you for up to this amount of loan size based on the Air DNA report. Whereas like if it's a long-term rental, we do need to wait for the appraisal typically to come back and tell us where that market rent is. But with that short-term rental side, hey, we have the qualification up front there as well.
That's great.
That's good stuff.
So Tanner, a new borrower, maybe they're not a new investor, but a new borrower comes to you today and they fill out our link and they say, hey, I've got 123 Main Street under contract. I need lending. What do you recommend for the borrower to have in mind? What do they bring to the table day one to make the process as smooth and easy as possible? What should they have prepared before they even fill out that link?
I would say the easiest way to get the process moving would be just to have a good understanding of what you're looking to get out of the property, whether that's, hey, I already have it under contract. I know I'm operating at a short-term rental. Just have a clear-cut plan and then being able to communicate that to me effectively. And really what we try to boil that down to is I have a short list of items and I could potentially include that in the description, but it's just a short list of items: property address, property taxes, insurance, a lot of property cash flow specific information that when you do send it to me or you do send this information in, I can quickly generate some soft terms for you, send them to you, and then go from there. Because at that point of me sending a term sheet, if you like the soft terms, hey, let's really then get the ball rolling as far as here's a loan application, here's a credit off. And so I'll definitely be walking the borrowers through the entire process. I mean, I'm going to be available by phone call, text message, email. But really to get the process started up front is understanding your investment strategy there, whether it's a long-term rental, short-term rental, and then also having property cash flow specific information.
And that was great when I worked with y'all previously. I very quickly had a term sheet and I was like, nice. Like it was fantastic. Of course, I was a cash out refi. It was a little bit easier. I already knew everything, but
yeah. And if an investor is ready to go with a purchase like property, they already have it on contract, for example, or maybe they're writing an offer, being able to get those term sheets, that's really when the rubber meets the road of, hey, here's what the loan looks like, right? If you'd like the loan terms here, then let's really get the ball rolling. And so the first step for me is always, of course, having a phone call with a borrower, discussing their strategy, what their background is, of course, communicating what we do as Easy Street, what our loan products look like, and then getting in that term sheet within, I imagine I got it to you within an hour. That's typically, if you provide that information to me, I'll get you some soft terms typically within an hour or two.
So I want to ask, we've talked about short term and then long term. Medium term rentals have been kind of like become popular, even though we've been doing it for years over here.
Mhm.
That's kind of like the popular thing. Do y'all like kind of do something like that? Like, because medium term rental numbers are not like there's Airbnb can't really run them. Like honestly, like we kind of make up our own numbers. Is that something that y'all do or?
Yeah, we do. We can do medium term rentals. Typically, we'll qualify them as a short term rental.
Okay.
And then they can of course operate it as a medium term rental as their property.
Right.
It's going to be very similar, but AirDNA would be what we use to qualify. What I see sometimes with like medium term rentals would be like rent by the room, or maybe it's like some sort of boarding house, or like maybe like a student housing. The rent by the room is going to be a deal breaker for us.
Really?
So we don't want to see.
That means
Yeah.
risk, right? You see higher risk.
Yeah, and part of that is the functional obsolescence that usually comes with these properties that are rent by the room. And what I mean by that is sometimes they'll put up like dividing walls. Maybe they put some random doors in different areas that it just doesn't make the property as easily sellable on the secondary, or on the, if for example it got foreclosed on, the buyer pool shrinks tremendously because now there's a lot of functional obsolescence with the property on those rent by the room structures.
That is so interesting. That makes
Yeah.
perfect sense. Because
Yeah.
they take out the dining rooms, the living room, everything becomes a bedroom, and they're going, but look at my cash flow. And you're going, risk. Figure out,
Exactly.
this is cool.
Yeah. So yeah, talking to your point though, Chandler, medium term rentals, we can do them absolutely.
Okay. Cool.
Yeah.
I just didn't know if y'all ran into an issue with like kind of running numbers. Like, oh, okay, I don't know what numbers this is going to run.
Yeah, for the acquisition, it would still be the AirDNA value, and worst case scenario, we just use the long term rents because typically that's going to be lower than the medium term rentals, and that's going to be a bit lower than the short term rental. But the long term rental is going to be the easiest way to back into a medium term rental if the situation calls for it. And that would be getting an appraisal market rents and then qualifying through that route.
Cool.
Yeah.
To add on to Chandler's question, what if someone was going to do it, turn a house into a short-term rental or a medium-term rental? They're going to need money to furnish that. Are they able to borrow some of that as well? Tanner, do you have a way to do that?
We do not. So our mortgages, our loans are specific to the real estate as collateral. And so similar to like the mobile homes, if we're giving them a loan on some furnishings, those could disappear overnight and now our collateral is gone. And so we don't have, we're strictly real estate.
Okay.
Yeah.
I just thought it was worth asking. I've never heard of a bank doing.
Also, that was a good question.
Yeah.
Never hurts to ask.
I mean, I have some contacts if if somebody was needing some money. I mean I have some contacts that, hey, here's a business loan officer that can potentially get you some funds for furnishing, but that's going to typically be the route you'd have to go if you need some funds to finance the furnishings. It's like a small business lender type of scenario. Yeah.
Cool. What would you say is like the most popular type of loan that you're giving out right now?
It's definitely the rehab loans. So as part of that 100 million, we're roughly 70 to 80 of that is the rehab loans. And then 20 to 30 is DSCR. We actually crested our best month for DSCR was 31 million 2 months ago. And so it's certainly the rehab loans. Those are going to be our most popular product. And part of that is, like I touched on already, is we're qualifying you up front. And so there's no final changes to terms or telling you no at the end, the finish line. We actually win so many deals because A, we can close really quickly, and B, some other lenders change terms, or they say no at the finish line, and it's like, hey, well, we only have 4 days before our contract closes. Can you guys do this? It's like, well, submit it to us. Let's go through the process. Oh, we got you a term sheet. Yeah, we can do this. I'm not going to tell you 100% yes until I get you that term sheet, but after that, it's yep, hey, we can do this. And so we win a lot of fallout from deals like that.
I'm sorry, Tanner. When you say a rehab loan, you mean most of your loans are purchase plus rehab money to rehab. You're not meaning just only the rehab. You mean the purchase price plus the rehab.
Correct. Yeah. Mm-hmm.
Interesting.
It's a good model. We can turn around and DSCR it.
It's roughly 30 to 35 days today for the DSCR. Yeah.
Cool.
And part of that is we do have an appraisal requirement. You're not going to run into any lender on the DSCR side that doesn't have that. But we do have an appraisal requirement that typically takes 2 to 3 weeks to get returned. And then once we have a full file, so that's all the documents in, the appraisal in, we typically close within 2 weeks after that. So, I mean, we've closed DSCR files in as little as like 19 days, sometimes like 17 days. It's really just typical is 30 to 35 days. Give us 2 weeks once we have everything in. But if we did like a rush appraisal, you submit everything in the first couple of days. Hey, that's when that 2-week period starts for the underwriting review for the DSCR side. So we can do faster, but yeah, average is 30.
Okay, I have an agent question for you. And I know you're familiar with the contracts, the sales contracts. So we literally have three options when we're writing a purchase and sale agreement. We have conventional loan, FHA, or cash. So a DSCR, that would go in as conventional. Is that correct? I've heard
No.
different theories. Would that go in as cash?
I typically see cash the most often.
Okay.
It's really just typically it's a matter of whether or not the seller is going to be okay with non-QM. Sometimes you can explain it and discuss with like the listing agent, and of course if it's owner, sell by owner, the owner, the seller, and just say, hey, I'm going the non-QM tradition or the non-QM routes. These are non-QM loans, so it wouldn't fall into the conventional
Okay.
or FHA. Of course, those are going to be owner occupied. Yeah, you're gonna probably typically do cash on the
Cash with the
contract.
ability to finance. Okay. That
Yeah.
makes sense because whenever we're using hard money, so it's kind of like hard money. The DSCR is in that vein instead of because we always have to disclose that, to the seller how you're going to pay for it. So, okay.
Right.
But I've asked that question 10 times and I've gotten 9 different answers. So,
And you ask me tomorrow and I'll probably give you a different answer because I've seen a different contract and it seemed to go more smoothly. But typically what I see is the most smooth is telling them it's an all cash deal, but also of course communicating, hey, I am going the non-QM routes. Okay. It's actually an easier qualification. It's pretty rare for you not to get qualified on the DSCR side. If you have great credit, you have the cash to close. It's going to be typically pretty easy to qualify.
What kind of things do you see come across your desk that makes your hair light up with risk and you say no? What do you say no to? What freaks you out as a lender?
I would say if somebody is because there's sort of a misconception with the DSCR loans as far as a lot of people think they can get 100% financing because, hey, the property cash flows. Why can't I? It qualifies at 100%. Why can't I get there? So people typically who are saying, low money down, or they're telling me that I'm going to fund the down payment with like investor funds, or, hey, are you comfortable with, creative financing, like seller financing? We do like to see that the borrower has skin in the game.
Okay, that's a great question. So if I'm saying the seller is going to finance 20% and I'd like to borrow 80 from you, that's a no?
That is a no.
You
Yeah.
want me to have cash, some cash.
Correct.
Okay.
Yeah. We do allow for gift funds. So, okay. We just require that at least 5%, if they're going to do gift funds, 5% is coming from their own funds. But we do allow like gift letters and gift funds if they have some family members or friends that are going in on it. The easiest way if they're going to do investor financing is going to be doing like an LLC or something that they maybe an investor just a 1% owner in the LLC. And then they're pulling the cash from there. Hey, if that LLC is buying the property, that's the guarantor, or the borrower is the guarantor, but the LLC is buying it and they're on the loan. Just 1% owner for the investor. So there are ways around it. It is a red flag. Like, hey, where's this money coming from? We're going to need to really dive deep into their 2 months worth of bank statements to make sure that this money isn't coming from like an unsecured credit loan, for example. That would be a big red flag.
Yeah. Again, you see on social media, I bought $5 million worth of real estate with no money down. And I'm always like, how?
Yeah. Typically it's seller financing mixed with maybe there's like some private lenders that are more comfortable with that type of strategy. But the no money down is pretty tough. It's usually a fugazi. It's smoke and mirrors trying to get you to buy their course. But
There you go.
Real estate, typically you do need some money typically into the deal.
Yeah, no doubt. That's always one that I get. Like, oh, you need some money, and I'm like, yeah, you do. There's so many people talking about no money. Um, which maybe somebody's going to come on here and say, "Here's how I did it," and I'll be okay, I believe you. But
And I think also it's sort of like a catch-22. They say it's no money, but it's really just a BRRRR where they pull all their money out.
yeah,
And then they're using that to then continue their process. Which, like I said before, is possible, but it's really rare today to even get that specifically where you have no money into the deal effectively after you've got it rented and refinanced.
Well, I'll give the counterpoint here. I've bought a ton of properties with no money down, but the down payment came from my line of credit. So I used the line of credit as my cash, and then I had a conventional loan,
yeah.
for that 80%. So I actually have done it over and over, but I was on the hook for the whole enchilada.
Okay.
Maybe
Yeah. Well, the cash is coming. So I guess if in that scenario, yeah, we would allow like a HELOC to
Okay.
use as a down payment. The difference would be we just can't allow, or we don't allow, unsecured financing to be part of the down payment. As long as it's secured by some other collateral somewhere, hey, we can use that. And so if that is qualification as no money down, I mean, you're still putting 20% of your HELOC in. I mean, you're still pulling funds from out of some equity you have somewhere. But hey, if that's no money down, there's a lot of, we do work with investors that do that.
Okay, that's good. That was it hit me. I was like, wait, I've done it, but not, So anyway, that's cool. Wow, it's so much good information, Tanner. I'm really enjoying like throwing everything at you. You're killing it.
Yeah, I've enjoyed it. Y'all have had great questions. And I enjoy talking about the risk side of, as you can tell. I mean, I enjoy, because I like to understand the why, right? I mean, that's sort of my own personal philosophy is, okay, well, this is like this, but why? Why is it like this?
Maybe if you tell me no, but I want to understand why. And you hear all these, well, it was a no. Well, why? What's the risk? I'm a great borrower from my perspective, but I want to see your perspective. So I'm really hearing it, from the lender side.
Yeah, and if any borrowers reach out to me and they're asking me the same questions, I will still give them the reason why, as well as, hey, if a credit decision becomes a no, like on a DSCR loan, I'm not going to tell you, hey, it's just a no-go. I'm going to tell you why. And typically I'll offer pass forward, right? Like, for example, if the appraisal comes back and this is a scenario I ran into recently. The GLA was wrong.
Which is
like the county had it different. It was like this enclosed patio that the appraiser just wasn't considering as part of GLA, but it had all the metrics that are required. It had heating and air to it. It was completely enclosed. There was a door to the outside. It was completely finished on the interior there as well. It wasn't like concrete or patio anymore. It was a real room now. And so it was like, hey, well, the value is much lower than what you need it to be because of this. Let's get a new appraisal. Like let's have a real optionality, a path forward to closing this loan, because I want to close these loans with you. Like, we're in the business of lending money. We're not just going to tell you no just to tell you no. We're going to tell you no, but also offer paths forward. Hey, your credit was poor, but we found that it was like, credit utilization is high. That's one of the big factors. Hey, maybe you pay down some credit cards, come back to us in a month or two. Let's repull your credit and let's get this loan rolling. So
cool. Yeah. And is there something that we're missing out on that maybe we haven't asked? Or have we pretty much touched on everything?
Man, I feel like we're pretty much covered what I would expect I would have wanted to cover.
We've asked questions
of course,
I've never heard asked before, and I'm proud of that.
it has been a fun call. I mean, I've definitely, y'all put me on my toes a little bit on this one, but it was enjoyable.
Here's one. Where can we find you? Like, if somebody wanted to reach out, what's the best place to reach out to?
So the best way is I actually have a LinkedIn. You just search me, Tanner Macklin. I don't think there are too many other Tanner Macklins in the world. So it's not going to be too tough to find me. I don't have two super duper common names. But other than that, it would be direct to email. And I think there should maybe my email in here, as well as I can put my phone number there as well. I mean, you can text me, you can call me. If I don't get back to you within, if I don't answer your call, for example, just leave a voicemail, I'll get back to you. The email would be the easiest way to reach out to me directly.
Well, and I've been working with Tanner and his team for a while because I have a lot of buyers. And so we're going to put our link in the show notes to where you can just click on it and you can type in the property info, and Tanner will immediately get on that term sheet for you as the buyer. So, and that's the way they would also get a pre-qualification letter. Is that right, Tanner? To use that same link?
Correct. Yeah. Yeah. A pre-qualification letter will be the same. And really you'd have to ask for that. So like the term sheet, if you submitted an application, hey, that's automatic. We're going to get you a term sheet. The pre-approval, pre-qualification letter, that will be a bit different. You will have to specifically request that. But that is no sweat. I mean, we can get that for you. It is specific to properties though. That's going to be another little bit different than what you'd see with like conventional. Hey, we're qualifying Miss Julie Gates for up to $400,000 on her home. Ours is going to be, hey, we're qualifying Miss Julie Gates for 123 Main Street up to 75% leverage on this property specifically. So it's very property specific, and that's why, hey, just ask for it if you are looking to write an offer.
Well, I'm glad you're touching on that because as a buyer's agent, it's my job to make sure they're pre-qualified before showing them a property. We're not even supposed to show without it. So I've told my clients 100 times, and I think you're backing me up here, Tanner. I'm like, just get a pre-qual letter from your regular bank, and then we'll use that to write an offer. But then after that, you can go search for the best lending possible. We can always change it. So I have done that many times, and people have been able to get better terms. And we don't care who closes the loan once you have the property under contract. So always consider when you're looking there.
Of course. Yeah. And I mean, if you get a pre-approval from us and then you shop it with another lender and end up going with them, my feelings may be a little hurt, but hey, that's business. If somebody else is giving you a better product, I mean, I can't say anything else about that. I mean, if they beat us, they beat us. Cool. And likewise, if you get a pre-approval from someone else, hey, shop it with us. We'll see if we can beat them.
Yeah, absolutely. Well, Tanner, we appreciate your time today, and thanks for coming on.
Yeah. Thank you for having me. It was a pleasure, Julie and Chandler.
Thank you so much. I've learned a lot. Thank you. It was really fun getting to just ask anything I wanted. It was great. So please come back anytime.
I certainly will once we have if we have some serious guideline changes or maybe some like new product or maybe like a new niche that we're trying to focus on in the DSCR space. I will certainly hop on and maybe cater the next one a bit more specific to like properties and how it actually looks like maybe with some Savannah properties too.
Awesome.
Let's do it.
Yeah.
Thank you so much.
Thank you guys for listening to that amazing episode on private money, hard money lending. What'd you think, Julie?
It was great. I had a great time. I really enjoyed picking Tanner's brain.
Yeah. And I want to say if there's like questions that we didn't ask I know when I listen to podcasts, I always have questions. I'm like, hey, can you ask this? I almost want to like jump through the screen and be like, hey, but if you want to ask, like ask in the comment section and we'll read it and we'll bring it up the next time we get a lender on. So don't be afraid to ask questions in the comment section. And also please like and share this as much as you can. We greatly appreciate it. And we will see you in the next one.
Bye-bye.